All right, I'm back with this weekend's take on things. Um, just to start, this is the kind of what we'll go through. I'm going to try to buzz through these today. The charts are pretty self-explanatory, and I have a lot of different news articles and snapshots. But this is what we're going to gradually be going through. The last thing in terms of the major secular inflection point is really what, to me, is the most interesting thing about this. But just so we can at least start with going through, I wanted to make sure, since the Middle East obviously has heated up again, and we've got another level which has finally had an impact on the oil markets. You won't ever really see me talk much about geopolitical events, mainly because, based on my experience, and I wanted this to just kind of represent it. This is from Yardeni, just highlighting the fact in each of the different things mentioned there, you can see the black lines. The market reaction it's varied. It has more to do with where you are economically, where you went on the earnings cycle, whether you're going into a recession or not. Generally, these things don't cause them. Sometimes they are really at a point that, like the Yom Kippur War in particular during the 70s, where there's such a big event. So if oil does make a major move, it'll have a much more important impact, but I don't think people should be focusing their attention on it. So even though it's an important event for the world, I just want to make sure I'm never really going to get involved in it, because I don't think there's any way that you can really trade them or even have an opinion on them. So first of all, since the last time I did this on Sunday and into Monday, there were more items released by the Chinese government focused on the home buying side. I've been shocked at how people remain on the negative side of China and saying this is going to fail. I'll keep saying what I've said. First is they are trying something different. Most importantly, when you read this, qualifications for purchasing a new home will no longer be reviewed, and there will be no restrictions on the number of homes purchased by families and single individuals. This is from one of the state government newspapers. They are trying to change this, and so as you read these others, the locals are going to move on it, and you've already seen it in the stock market. You're going to see it in the housing market. So to fade this at this point, it just makes no sense when you've had nothing since really 2020 when COVID occurred. You had the zero COVID policy. You had Russia's invasion of Ukraine, which started to have a huge exodus of money from China. I saw it from pension funds that said they wouldn't invest there. Stan Druckenmiller said he wouldn't invest as long as the current government is in place. So you've got people not involved, and these are just more news stories that are, I focus mainly on the state newspapers, but they're talking about the fact that this is meant to be something that works. So we're going to keep looking for signs. This is something that got released this week in terms of the PMI just for the steel industry. You can see in September, scored a 49, up significantly from August. You can see the chart here for the first time really since March, when there was a slight bounce. You're seeing a steady weekly uptick here. During the holiday, which they had this week, Railway Network set a record there. They've been setting records before, so I just wanted to highlight it, just that they set a new record during this. So people are out. There was one day that the market was open. The Shanghai Composite did have its best day since coming out of the crisis in '09. So again, the prior week, we had a big move. That's when they were announced. And then we get the biggest week on Monday post the property side. So the property market drives, and the government came out forcefully over last weekend. It didn't get as much fanfare in the U.S., but as I highlighted, they're doing things that just remind me of, they're really firing like Mario Draghi did in Europe, and they're trying to get something changed here. The Hang Seng responded. This is the weekly move. So we had the biggest weekly move since the great financial crisis. And again, this is not the first week, so this is the second week. Same thing happened here. You had a 17% move in the Hang Seng tech sector. That was after the week before move on the announcements. Just to give you an idea why I keep focusing on this, it'll be part of the inflection side, the inflection turning point at the end that I just want to bring up. But this is it, the Hang Seng relative to the PMI in the U.S. If China all of a sudden has a change and their property sector changes for a bit of time and their steel sector is trading higher, you're going to see increases in the PMIs going forward. So you want to watch the Hang Seng to just see how much this is happening. In terms of the U.S., this was, to me, really important. I highlighted last week the upward revisions to the GDI. This was an argument that a lot of people had brought up as why we were headed into a recession. But the fact that Powell in the Q&A specifically mentioned GDI, this is from Nick Tamareos, who's one of the Fed speaker, or one of the Fed newspaper speakers for the Fed, just reporting on it, removes the downside risk there, also mentions the savings rate. So, Powell kind of started a little bit move higher and starting to take out some of the rate cuts, as he said that last week's upward revisions were definitely important. In terms of the payroll number, I'm only going to show this. People saw that it was, a higher than expected number with good hourly earnings. I've talked about this. I use the aggregate weekly payroll. This is now the 3-month average. You can't even tell. We're still right in the same area there. So jobs are fine. The diffusion index for 1 month jumped back up to 57.6. I don't even want to talk about it. The labor market's completely fine. The claims will be the only thing that you should look at. I do want to remind people that whether it's the JOLTS number, the household number, the non-farm payroll, the ISM manufacturing, the ISM services, one common thread between those 5, they're all surveys. You've seen where consumer confidence is. You've seen where small business optimism is. Using surveys is disconnecting from actual data. I do not understand why people don't use the continuing claims and the weekly claims more, which are actual datas of insurance. It's been right. Everything else that people have used to say that the labor market is headed into a recession has been wrong. We have a soft labor market. That is no doubt. That's showing up by less hiring, but there's a difference between less hiring and no firing, or at least low firing still. In terms of data that stood out, the ISM services came out. This is it on a standard deviation basis relative to the expectations, a blowout number for the headline number. The new orders component for the quarter was up 12 points. So new orders came in at 59.4. So obviously at the end of June, it came in at 47.3. This is the second largest jump in the history of the series, which goes back to 97. The only one more was literally coming out of the great financial crisis. So the new orders component of services, which is the bulk, obviously 70+% of the economy in the US, is there. When you look at new orders, less inventories of the service side, you get a similar story. This is the 1 month jump. We saw an 8-point jump or 7.9 jump. The second biggest since 2012 coming out. This is post Mario Draghi. You got China this time. So I would just say at this point it was a strong week for economic data. And that led Larry Summers to saying what I wrote last week in here, which is questioning, in hindsight, the 50 base point cut in September was a mistake. He went on to say not of great consequence. They're still going through it. But we're getting more people starting to talk about back to no landing. And I would say at this point, the mistake thing is going to start to pick up unless we see a change soon. And the change I mean is, this is the City Surprise Index, the green bars, green and red bars here. So last week, the City Surprise Index, which again, just means beating estimates by a significant amount. It was up 20 points for the week, which was the highest one since June of last year. You can go back and look whenever we've had these big spikes. This one occurred right at a change of 10-year rates. So this is 10-year rates after. In here, we were already starting an uptrend. We just moved 10-year rates down. So I've talked about the fact that I believe inflation is going to be the surprise going 3 to 6 months out, that we got a little bit too excited about it right when everybody started cutting rates, and that we're going to see an upturn. This is 2-year break evens for tips. We had a big sharp move now. We had been moving down. This is overlaid with 2-year rates. So 2-year rates and tips. This red line here, this is when the Fed decided to cut 50 in surprise. So the low for 2-year yields occurred basically right after the Fed's surprise by doing more than what was expected. And so you've had a rise up in 2-year break evens. And one of the rises is because we're seeing commodities go higher. So I mentioned we've had commodities go higher basically as part of the China situation. So we've had 2 weeks now of commodities go higher since China went through it. These are the weekly moves in the BCOM, but now we've got the risk premium into oil. So now you had oil join. This is 4 weeks in a row of at least 1.5% moves. That's what this white line is. You have to go all the way back to early 22 when we started to see commodities go higher like this, and that was when rates were at zero. So this is before the first rate hike. So commodities are starting to move higher, and here's the linkage between 2-year rates and commodities. So just as the market participants get excited about lots of rate cuts to come over the next 2 years, expecting the economy to go into a recession and inflation's under control, as I highlighted last week, core services have not come all the way down. It's been the good side, and if we see any uptick, and I said this 2 weeks ago, in China, which I now believe has been confirmed that we're going to see some change in China. It's just a question of how durable it'll be. But the problem is, if commodities are already having a run, and now you've got the Middle East built into it, it's going to attract 2-year rates to move to a higher level. And you have a job market which is still stable. And I just want to highlight this. This is the JOLTS openings. We saw a bounce back in it a little bit last week. This is it, the white line back to 2009. This orange line here is the human resources index for the S&P. That's the orange line. It has tracked very well, and it's actually been a leading indicator for the JOLTS in terms of hiring. Well, it's gone up, and it's at the highs of really the last 2.5 years now. So we're seeing a change, at least in the stock companies there. We'll see if it translates. I didn't show the claims, which were near unchanged, but I thought this was a good thing that came out from B of A this week. I just want to highlight two things because they bring up the point that I brought up about a month ago in one of my videos, that the SOM rule is ridiculous to use versus claims. Claims is a much better way to go. The unemployment rate is skewed, partly because of the survey, partly because of the immigration. But more importantly, this jobless claims number, and this is what they highlight, when you've had this kind of rise that has triggered the SOM, this is where jobless claims have been, and we're below it. Now, the only time we've been even close to here was back in 1970. In 1970, the population was 200 million people. Now it's 340 million people. So this number, to be effectively the same as theirs, should be closer to about 350. We are at insanely low levels of jobless claims. So until that changes, you're just going to keep hearing me talk about it, and hopefully give you the ability that whenever people start worrying about a recession, and the recession obsession starts by the perma bears, you have a chance at that point to start to look for opportunities. I want to remind people, because we're getting close to it, that core CPI has tracked higher month over month for the last 3 months. That is with gas at the pump going down, and even though this is core services, there's usually been a linkage. The fact that it was 0.28 on the most recent reading, if I go back and look at how many times we got a 0.28 reading in the period before 2020, you're dealing with 1, maybe 2, 3 times out of about 10 years. So 120 data points 3 times. The fact that you're still getting these type prints, inflation is much stickier than people realize. So I think you just have to pay attention. But this is the other reason why, now that we're not talking about a recession right now, we've got stocks at all-time highs. It's not just the U.S. The other major economy in the world, China, just did their stimulus. So here's where we are now. This is the biggest month of monetary easing since April of 20. So you're at a point now where you've had a tremendous amount of easings globally, and so what you have to start to focus on is stocks as we kind of get through this period. We made it through the recession fears with 2 good payroll numbers. We got the Fed to do more than expected. China came out with their version of a bazooka, and Japan basically said we're going to hold off for now. The S&P was up again. This is over the last year, so we're entering this period. This is the last 11 months. So far this month, we're basically unchanged. When you go through what's happened, I thought these were worth showing because we're at a point where now that you can put in the context that the Fed cut rates with the S&P at all-time highs, if you don't get a recession, Goldman Sachs put this out, this is what you can expect in the next 12 months from the rate cut. So from that first rate cut, what happens if you don't get a recession? Another one to look 2 years out. Basically, if there is a recession 2 years out, you're down here. If it's a growth scare, you're up here. Earnings, this was from This had a bunch of different components, but basically to say that the Fed is cutting into accelerating profits, it's unusual and it is definitely pro-cyclical. So to go into a recovery and to be cutting earnings is not normal. To have S&P ROE basically up here, and I just wanted to highlight that the current reading of 20.7 for the S&P 500 ranks in the 97th percentile versus history. It was expanding margins are one of the components. In terms of the estimates for the next year, here's where the 2025 earnings consensus is. This is Goldman Sachs. I don't even know what to say about this stuff in terms of people to expect a recession where no matter where you go, it's just not showing up in anything. You're asking for a very big change, and you've got all the central banks easing now at a time when it just doesn't seem like it's necessary. Seasonals are important this time of year always. October, November, December. The bar here is the blue is the performance monthly return since 85. So you have the two best months coming for October and November. The blue line here is the percentage historically of positive returns in those months. More importantly, Goldman I think this is from Goldman, got a little bit more exact with the date here and said, here's the seasonal component. So starting right in near the last week of October, when most of the gains historically have come when you go through the seasonal pattern. So that's where we are on that front. This is where I'm just going to kind of finish things off with this inflection point. So I'll start showing you podcasts that had an impact on me. I do listen to a lot of different podcasts. Louis Gov is one of my favorite people to listen to. I've been waiting to see him speak post the China stimulus. I highly recommend listening to this. It's 1 hour. It's with, I think it's Thoughtful Money is the name of it, but you can just go find this. A few things in there that are just worth it. He talks about China's move, why it's real. He goes through the history of the moves by China and how they've worked out. He talks about changes in Japan governments and the Bank of Japan. Talks about the deficits of the West, which these are all new, and goes through kind of their 4-quadrant framework and where he thinks things are. But the main point of what I want to do is he's talking about a sea change in repatriation away from the West. And I think with what happened in China, what happened with dollar yen, the move we've seen, I do believe, as now people seem to believe, they can jump back into shorting the yen. I do not think that is going to work once we get the next move in it, which I think will come. I think there will be a repatriation story. I think China's decision to go is going to draw more money back towards Asia, and I think Asia has been sitting waiting to grow, and China's been a major negative. One of the interesting things that Lewis said in this podcast is this quote, which I believe is right. It kind of hits the sentiment. In the space of 3 weeks, we moved from ABC, which stood for anything but China, to new ABC, which is all in by China. I think that's the perfect way to put this. In terms of their 4-quadrant framework, and this is really important because this is something that I've talked about, and I absolutely do believe I'm talking a lot more about inflation. I think if you look here, we've been in a disinflationary boom really since the end of 22. And I say the end of 22 because we got a peak in inflation, up near double digits, and it started to move lower, and it's been moving lower and continues to move lower. And that led to a massive outperformance, beginning from them, of the tech names. We had an inflationary boom before there. So an inflationary bust is going to be if oil kind of races up to 120, 130 on the back of the Middle East question. I think we'll be there. But I think for now, we're kind of, the market's acting like we're in one of these situations. Now that the Fed is cutting rates and China has gone, I think we're moving into this. I think we were headed to this anyway, but I think with the central banks going, and he talks about this. Now, the reason I bring this up, the boom of 2021 by Charles Gov, he wrote this in early 2021. And this is what he put in. This is way before inflation. This is still when people were for the most part, worried about what was happening from COVID. And I bring this up just because, A, they've had a good call, but secondly, I think they're very thoughtful on turning points like this. But they know China, and when you listen to it, he is very thoughtful on China. There's no emotion. He's not a perma anything on China. He just knows the region really well. They've been in Hong Kong a long time. So I highly recommend to just get at least an opinion that doesn't start with nothing will work, when we've lived in a world where, whether it was the housing crisis in the US, whether it was COVID, whether it was Europe breaking apart, there's always a situation where nothing can work. Japan, but you can find ways that you can turn things around if you just print money, and that's where I think we are. So if this does turn, you've got the US, this is the ratio of the US market over the MSCI World X the US, and it's just been a straight line since 2008. This is when the iPhone came out. This is the beginning of the mega cap tech names. That'll be a big part. We're now at the point where the US is now 50% of the world market cap. It's actually more. MSCI World, I believe it's about 72% right now. This is kind of part of what he brought up, and I think this is important. This was a news story this week, and from Bloomberg, and it just talks about, Japanese investors snapped up a net 192 billion of the nation's government bonds, largest amount for the time frame in at least 14 years. There's definitely a change happening. There's a quote in here. It's going to be one of the mega trends in a super cycle for the next 5 to 10. If you can find turning points where the river starts changing the other direction, you can be in a position to catch things. And that's why when David Tepper goes on and says these stocks are too cheap, you're starting from a position or too cheap. That's the way the U.S. stocks were in 1980. And I think we're in a situation where you've got a similar situation. And I think another catalyst that's happening is the Western world has just basically given up on austerity, and the situation gets worse going forward. So I just put this in here. This is from an IMF blog that came out on September 16th, just talking about the fact that it doesn't matter which side it is, they're all looking and basically have come, governments promising more spending going forward. So we've entered a world here where we're not worried about inflation, we're not worried about default, so they're just printing. I brought up my Substack just because most of these articles, you can see the US debt crisis, I do spend time on this, but I also go through the negatives that come from printing and the deficit. So as much as it's been good that stock markets have gone higher, I think we've kind of reached the point that an inflection point based on what China did, which was kind of turn the table on being austere to a degree and not wanting to get some kind of a boom. They capitulated, and for whatever reason, Louis Gov goes through the reasons why they waited until the Fed moved. I think it's important for you to hear it. I think it's interesting, and I think if it is an inflection point, we could be at the point the last time that we had both a combination of, I said China started to buy stocks here. This is dollar yen, or this is the yen versus the dollar. So you can see it was at a low into 98. At the same time that Hong Kong was under pressure, so you had the Chinese, Hong Kong said they would buy equities, and you got a big turn in dollar yen, and that point lasted, and it went the other direction into 2011. At the same time, this is EEM over the S&P. So emerging markets, which obviously have a high weighting towards China, started their rally as well, and maybe it continues on the same path, but the reality is I think dollar yen, which had a big move here, people are expecting it to head back to 160. I think it's more likely that this is the beginning of a turning point if China starts to pick up. Another area that I wouldn't be surprised is energy, but before we get into it, this is a point that is completely different, and I just want to highlight, this is M2. This is the dollar increase, the trillions of dollar increase that we saw in terms of N2. So when you go through this and you realize these are monthly numbers, these are outsized printing that happened, and now it's starting to happen again. So the energy sector, this white line here is energy relative to the S&P. It had a big rally into here. Then the Fed started to shrink money supply. Money supply went down, Energy underperformed. Now we've got an expansion again going on in money supply, and the numbers are picking up. The blue line here is EEM over the S&P, very correlated. So I think energy is another place. Just to highlight the Nikkei relative to the S&P. So even though the Nikkei has rallied, the white line here is the Nikkei relative to the S&P. The orange line here is the MSCI World relative to the S&P. They've moved together. So if you do get a shift here in terms of all those Asian dollars, I've highlighted to you that the Chinese M2 is twice as big as the US now. It was the same size in 2008 into 9. It was much smaller before that. That money has really filtered into a lot of US companies. And I like to see pattern shifts. This is the rolling 200 week. So figure rolling 4 years of the NDX relative to the S&P. The reason I bring this up is NDX relative to the S&P is unchanged now since 2020. So the 4-year rolling rate of change is unchanged. It has not been at unchanged since March of 08, and I showed you a bunch of charts there. This is really when the beginning of this outperformance started. I think the US tech, mega cap techs, I don't think they're going down, but I do think they're going to start underperforming the world, and that's what started to happen with China. So I do not believe this is a short-term trend. I think this is a beginning of a secular change of global repatriation where the dollars are flowing. The Asian money is flowing back to Asia, and at a minimum, you're at an entry point, which makes sense. So I would continue to not fade China. I would just do your research on it, figure out if you agree with it or disagree with it. If we are going to see an expansion in emerging markets, this is the other thing that I still think is the major benefactor, which is Bitcoin. The more money that emerging markets make, the more money there is for people who really don't like their currency, don't like their government, don't like their banks. If their stock market's going up and they're making money, you're going to see more money flow into it. Bitcoin hasn't broke out yet. I wanted to show this because the MACD is about to cross over. I think if we get a breakout, this will be one of the big runs in Bitcoin. And just to finish off this week, people had asked about how I created some of the indices that I use. And this one I put into Twitter, but in case you didn't see it, this is me using ChatGPT. The entire time I ran some Python code to, which you can also ask ChatGPT to do using Yahoo Finance, which has all the prices. I just go through and I get the data for the individuals. This one is using copper, gold, and QQQs. And then ask it to do a linear regression, which makes it tighten here. I only wanted to show this just because people have asked. AI is a big part of the way I do a lot of these videos. It's a lot of the way I process podcasts and things too that I don't want to listen to. I just get the transcripts and have it read to me. But over time, as you guys have more questions, I'll add it. So that's it for this week. Global repatriation is the theme. I'll see you guys next week.